Welcome to another episode of the Technical Insights. Today I'm with Heath Bedford and we're discussing investor versus owner-occupier lending on a macro level, which we include in our national report, and renters versus owner-occupiers on a micro level. Hi Heath.
Hi Sharon.
Heath, why do we look at the breakdown for investor lending to owner-occupier lending on a macro, on a national level?
Yep, very good question, Sharon. It's a very important statistic to look at. Obviously, we need to look at it for the general health of the market. So owner-occupiers typically make up a majority of the market, typically around 65-70%. And if we start to see that changing, then that can cause some volatility within the market. And that's exactly what we saw sort of mid-2015, where for the first time investor lending started to overtake owner-occupier lending. So that obviously started to create some concerns within the banking industry, and APRA stepped in and tightened up a lot of investor lending requirements, and we started to see that pull back to more normal levels. Yeah,
which is what we're seeing now. Why do we want to be investing in a dominant owner-occupier dominant market?
Very good question. Look, we analyse this at a suburb level across all the identified suburbs that we're looking at. It's an important metric for investors. Ideally, they want to be buying in an area that is dominated by owner-occupiers. For us, there's four key considerations why we want to do that. Stability within the market. If we start to buy in an area where there is a lot of speculation or a lot of heavy investment activity, typically developers will see a dollar. We'll start to see a spike in construction activity, and that exacerbates the boom-bust property cycles. Okay, we want to try and avoid that. The second point is capital growth. So owner-occupied dominated areas have proportionally had higher capital growth for a number of reasons, and a lot of those are emotive reasons. Owner-occupiers generally take more pride in their property, will value add, etc., etc. Liquidity, very important as well. So very important to have an exit strategy for an investor. So an owner-occupied area will typically hold their values, particularly in a downturn, a market downturn, as opposed to an area that has a lot or a larger portion of investment activity. So a good example is the mining towns, exactly what we're seeing in the mining towns now. With the mining boom coming off, in some regional mining areas, prices have declined 50%, 50-60%, and it's almost a race to the bottom, and a lot of these assets are unsaleable. So it's important to have that exit strategy, particularly if owner-occupiers are making up 65-70% of the market. When it comes time to sell, we want to be appealing to that portion of the market.
Got a larger pool.
That's right.
So what is the ideal... Sorry, was that all four?
No, there was only three.
No, what's the fourth one? Sorry.
Just cut me right off there, Sharon.
That's all right.
The fourth one is cash flow, most importantly. So we can't look at the proportion in isolation. We need to also overlay that with vacancy rates. Okay, so obviously we want enough of a tenant pool there that the property is going to rent, and rent quickly and rent well. We don't want to be competing with too many other landlords and other properties, because that will ultimately put downward pressure on rents and increase vacancy periods, and ultimately downward pressure on prices. Conversely, we don't want to be buying in an area that is too heavily dominated by owner-occupiers and where the vacancy rate is high, because that might indicate that whilst it's appealing on that metric alone, there may not be strong rental demand.
Which is what we were seeing in Perth last year with the high vacancy rate, knowing though that it was coming towards the bottom of the cycle.
That's right, yep.
All right, so what is the ideal breakdown when we're looking on a micro level?
Well, performance property, when we're analysing the suburb level, ideally we want to be buying below 25% owner-occupied, investors.
Investors,
up to sort of no more than 35, ideally. If it's a 50-50 split and vacancy rates are high 2% to 3% and above, that's alarm bells for us, and heavily avoid. And obviously, as you get into a greater share of investment ownership, then we just avoid those areas completely.
Excellent. Well, thank you very much. We do have an article on this topic as well, which can be found at performancedata.com if you'd like to read up more on this topic.